thank you for joining us for the May edition of the Optimize Monthly Market Update. Today we'll be discussing not only some of the important market events that have transpired over the past month, but also more broadly our perspective looking forward. My name is Matthew McGraw, President and CEO of Optimize Wealth Management, and I'm truly excited to take this opportunity to share an update on what our investment committee here at Optimize is seeing in the markets. Of course, we continue to evaluate the market events over the past month, as well as drivers of long-term focus, although the focus this past month has certainly remained on economic growth, corporate earnings, and interest rates. Notably, the latter has remained at the top of the headlines throughout this past year, as the Federal Reserve has taken assertive measures to curb inflation. But after having raised rates swiftly in a very short period of time, we are potentially at an inflection point. In early May, the Fed raised rates by a quarter point, bringing its policy rate to slightly above 5%. This marked its 10th consecutive rate hike since the beginning of this tightening cycle in early 2022. In this very short time span, we've seen roughly a 5% increase, making this tightening cycle the most aggressive in over 40 years. At the Fed's May meeting and the more recent Federal Reserve Open Markets Committee meeting, the tone has substantially changed towards hints of a pause and likely a conclusion of the current rate hike cycle. Any change in the policy rate will certainly hinge on the inflation print, which has come down significantly since the highs in June 2022. The most recent United States CPI index, for example, showed that consumer prices slowed below 5% in April for the first time in 2 years, which may give some room for the Fed to pause rates. Historically, the Fed has never stopped raising rates before its policy rate exceeded the rate of inflation. But with headline inflation now at 4.9% in the United States and the Fed fund rate slightly above 5%, a June pause would be certainly in line with the historical trend. From our perspective, it is likely that the Fed will keep interest rates steady throughout the summer, and with inflation above the Fed's 2% target, it may certainly take some time for rate cuts to start, particularly as the economy has proven to be resilient, supported by low unemployment. For the past 4 decades or so, it's important to note that a Fed pause has been a positive driver of returns for portfolios that include both equities and income investments. In fact, historically, after the last interest rate increase, policymakers on average held rates steady for about 6 months before beginning to cut rates. From the last Fed hike to the first rate cut, stocks performed strongly in 5 of the last 7 instances, with only slight declines observed in the remaining 2 cases. Additionally, when looking at equity performance, in the 12 months following the last interest rate hike, we have indeed experienced very strong relative returns, with large cap value-oriented companies leading the way with an average return of over 27% in the last 5 cycles. Although every cycle is of course very different, very unique, and the path forward may not be linear, markets are indeed gaining clarity as we turn the corner on interest rate hikes and inflation. For example, in the first quarter, there was a lot of emphasis on corporate earnings as we continued to see companies across the board navigating the waters of changing consumer demands. The tail end of COVID-19 supply chain issues, for example, as well as forward guidance now that companies have had to fare with several quarters of high inflation. A clear trend when looking at the S&P 500 components is that most of the index returns this year to date have been driven by the largest companies across the board. The 5 largest companies in the S&P, in fact, had an average return of over 22% by April 30th, and the 6th to 20th largest had a combined average return of 17%, above the 8% average return across the entire index. These trends demonstrate clearly the importance of active management within any client portfolio. We have continued to see frequent leadership changes in both asset class, sector, and industry, which has provided tremendous opportunity for Optimize to bring value to our clients' table. With that said, I do want to thank you for joining us for this month's Optimize Monthly Market Update, and we certainly hope to see you again next month.